Today, our focus is on innovation, and particularly what CEOs around the country think about how their companies are doing in innovating. According to an EY survey, half of C-level executives say their organizations spend more than 5% of their annual budget on innovative initiatives, yet 42% cite a limited budget as their biggest barrier to activation. We welcome now Mike Inserra, EY America's Senior Vice Chair and Deputy Managing Partner. Still with us is Mark Stoeckle of Adams Funds. Okay, welcome. It's great to have you here.
Thank you. Thanks for being here.
Tell us what you found.
It's an amazing survey. I think what you keep seeing is people are investing in innovation, but no matter what they're investing in, they feel like there isn't enough of that investment. You cited the survey itself today. Executives spending more than 5% on average of their budgets and feeling as though they're not really getting the returns on it. But we're not so sure it's about the level of investment. We think it's more around the assets getting trapped in a very fragmented way within organizations. Innovation's new, and so it's got a very unbridled element to it, and you want to kind of let it incubate, but at the same time, you've got to add some discipline in order to make sure that the assets are getting put together.
That sounds like you're saying centralization facilitates innovation. Is that what you're saying?
I am not saying that, but, but I am saying a little bit more framework around it. You do want it to be dispersed within the organizations, and we feel like using innovation hubs and pods within your businesses is a critical way to stimulate it, but at the same time, bring it forward so that it can actually move through the organization. What's often happening, you have great people in the field around products or serving customers, but they don't have all the ingredients to kind of add enabling technologies, and often they reach stopping points within the organization. So there are elements of that, absolutely, but this is not an intent to try to create a big center here.
So this is obviously like a big theme in the market, Mark, right? So how do you play it?
Well, I think it's it ends up being, let's take energy as an example, because I think energy is one of the sectors where there's an amazing amount of data, geological, seismic, and everything like that. And using machine learning can help you find places in rocks that you can drill better, drill longer laterals because of what you've done. And so I think trying to understand which companies are using that data most efficiently. I think energy is doing a good job, certainly in healthcare. And there are a variety of different sectors where it's being used. But I think at the end of the day, and tell me if you think I'm wrong, at the end of the day, I think it's machines can do a better job of taking vast amounts of data and analyzing it. And I think at some level, there's a simple part of that I think is important.
Right, but it's not just also when the companies see return on investment. I mean, some of the issues in the oil field services is that they put a lot of money in that technology that you say that we definitely need, and then there's no return on invested capital for years, and investors have to be patient. How do you deal with that on a C-suite kind of level?
Well, I think that's one of the challenges of C-suites in the C-suite today is how do you monitor those investments? And some of this is around, Alex, failing faster. Nobody likes to have a project that says this didn't work, right? But we actually think as you're using the technology, and I completely agree with you, the data is maybe the most critical asset of the future. Technologies and things like that are enablers, but the power of the data, what machines can do. But some of this is cutting your losses and cutting them quicker and sooner, and having a more disciplined approach and toll gates, which is the methodology we usually employ with, and I agree, energy and healthcare are probably two of the most powerful places that those returns are going to have it. But it's going to take a discipline level that's a bit different from the past. And
we saw that in healthcare. I mean, years ago, you would see R&D budgets, and you'd see they would take it too long. They would, bailing at the second as opposed to the third level. But they've done a lot better in rationalizing, and I think the way you stated it is perfect. It's you need to get out faster, and that gets down to good management and the willingness to do that. We tried, we failed, let's move on.
Mike, one of the things that came out of your survey was a big emphasis on artificial intelligence, AI as it's called. And one question is, do you build it or you buy it? To what extent do you actually do acquisitions? There was an interview that Michael Corbett, the head of Citi, gave to Financial Times just recently, and this is part of what he had to say. When you think of data, AI, raw digitization, please roll the prompter, of changing processes, we'll still have tens of thousands of people in call centers, and we know when we can digitize those processes, we not only radically change or improve the customer experience, it costs less to provide. So this is a big bank saying he's moving into AI because it's going to cost a lot less.
Well, I think there's truth to all of the above, but what gets people nervous when they hear that is all these jobs are going to go away, right? And that's probably true. What I think sometimes people don't think about is the jobs that are going to get created. We weren't talking about data scientists before. We weren't talking about the type of analytics. in terms of buying it versus building it, this is where I think you get into the notion of ecosystems. Because you think about when you go and buy a company, you got to buy it, you got to cut the deal close, you got to integrate it. That goes affront to speed and agility. So I see more partnering with organizations. I think you might buy elements of platforms, but you're much more likely to partner. And some of those partnerings may work well. Others may not, and you terminate them, move them on, and so forth. So I think that's the way you'll see some of this happening.
So Mike, and for that matter, for both of you, when is it going to show up as a practical matter? All this innovation investment, I'm going to show a sort of long-time chart of productivity in the United States, right? And the productivity obviously has gone up overall, but if you look at the lower chart here, that's basically the rate of growth. And certainly since the great financial crisis, it has not gone up very fast at all. You'd think with all this investment in innovation, whether it's the cloud or whether it's AI or whatever, you'd get more productivity. Why isn't it showing up?
Why isn't it showing up? I'm not sure I know the answer to that question, but I would talk to you about productivity, because I think that's one of the things that's extending the economic cycle we're in and maybe softening, the anticipation of continued recessions. Is that innovation and the use of technology in particular is continuing to prolong cycles. We're in one of the longest cycles ever. So you may not be seeing it in a much bigger bump up in the growth rate, but maybe what you're seeing is some smoothing in the productivity and how that's maybe softening out some of what would have otherwise been a much more wider volatility on economic
I think there's some shadow parts of productivity too. I mean, you take a company like JP Morgan. I mean, JP Morgan probably spends a little less than Google does on technology, but they spend an enormous amount on technology, and they are using it for credit. They're using it to crunch the data and try to figure out, do I extend credit to you or you, and how do I do that, and to what extent? So I think there's more there already. I think it's showing up in margins a little bit, but I also think that that AI and some of these machine learning things, they're so powerful that to expect it to be right now, today, I think is a little overzealous. I think you need to expect it to come down the road a little bit.
Right, patience, like we're talking about, like you have to wait for that return for capital. So just to wrap this up for us, Mike, what is the biggest risk for businesses going forward in this arena?
Talent. Attract the talent, retain the talent, continue to get the benefit of the talent. And I think you talk about energy companies, healthcare companies, financial services is a sexy industry. Obviously everybody wants to go into technology. I think the sleeper industries are many of these other industries that you're talking about that have to attract and retain this talent. And I'm seeing these industries really changing their workforce and how they attract those people and how they create an environment where these people see a real line of sight for the future.
I think one of the biggest risks could be you don't jump on board, frankly, for companies.